What's going to happen to interest rates is on the mind of most homeowners and many business people. So what is the Goldilocks interest rate? You know, that neutral interest rate that's not too low to fuel inflation, but not too high to force us into recession. That's what Dr. Andrew Wilson and I are going to discuss in this week's Property Insider video, together with a whole lot of other things that are happening in our property markets at the moment. If you want to keep up to date with our regular commentaries, please subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes out. How high are interest rates going to go? That's a question on the mind of many people who've got a mortgage, as well as most business owners. And over the last week, we received 3 important communications from the Reserve Bank telling us what may be ahead. There were the minutes of the July board meeting and speeches by both Governor Philip Lowe and Deputy Governor Bullock. And Governor Lowe intimated that the Reserve Bank's goal is lifting the cash rate to 2.5%. That's what the Reserve Bank roughly estimates the neutral cash rate is, the interest rate that's neither going to slow our economy down or speed things up. In other words, the current rate we're experiencing, 1.35%, is stimulatory to the economy, and that's happening at a time of high inflation and a tight job market. Governor Lowe said the policy challenge for the Reserve Bank is to return inflation to the 2 to 3% target range, while at the same time keeping the economy at an even keel. Clearly that's going to be a difficult task, finding the Goldilocks neutral interest rates. You know, not too low to fuel inflation in the economy and not too high to force us into a recession. So I'm looking forward to discussing this challenge with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Yes, good day, Michael. I'm glad you mentioned Goldilocks because I think the concept of the neutral rate and Goldilocks, both are fairy tale. Economists like to feel that there's some underlying force that they can tap into that makes their life a lot easier because they can find that underlying neutral rate and therefore they can work towards finding the goal of just right. But I think that they'll struggle to do that. Economists are always a little bit insecure in what they do, and it's because, you know, there is a lot of uncertainty in terms of economic modelling, just as there are in terms of any other reflection of the human condition. So I think even in their discussions, Michael, in the latest minutes for their recent meeting, they bailed out and said, well, you know, maybe there is no such thing as the neutral rate when they looked at the particular options that they had been discussing. It's a nice theory, but in practice, everything's on the move, Michael, and everything changes. And it's just the unpredictability, which we can clearly see over the last few years, that determines where monetary policy falls and rises.
Well, in the past, the Reserve Bank used to give some forward indication of what they're going to do with interest rates, but boy, they got it wrong over the last couple of years. They were telling us they weren't going to change the rates until 2024. Now they're saying how quickly they need to get there will be determined by the inflation outlook. But Andrew, the inflation figures that we get from the Australian Bureau of Statistics are really lagging. We get them 3 months or so after they've occurred.
Well, inflation numbers are due this week, Michael. They will be the results for the June quarter. We are just a week away from August. It's backward looking for sure. And given the nature of how they measure these models, the ABS, it will be skewed towards the early part of the quarter. And of course, you know, we're talking April and May, and a lot has changed since April and May, including higher interest rates. And unfortunately, it's a burden for our central bank, the RBA, because other central banks typically have access to more timely data on particularly inflation, monthly inflation data and wages data, which the US used to set its interest rate policy. Interestingly enough, we have interest rate decision in the US this week, Michael, and many are predicting, again, a 0.75%, maybe 1% increase in the official rate. But just getting back to that sort of neutral rate discussion, if we look back and you're right, the Reserve Bank certainly doesn't have a great record in terms of its forward positions, its forecasting. But if we look back to 2016, Michael, we actually had the official rate set at 1.5%, which is just above where it is now, of course, at 1.38. But it remained there for 3 years. And then it was sharply cut when the Reserve Bank finally realised that they'd got it wrong. And they cut rates at the back end of 2019. So what I'm just saying is that we had official rates on hold at 1.5% for a 3-year period, which was a record period And one would have suspected that that was the rate that the Reserve Bank had determined was the neutral rate. And this is my point. It's very difficult and, something really, it's irrational to try to work your way through all the differences that occur in our economies and society and the outside forces that can affect events fundamentally, such as COVID, such as the Ukraine war, and try to model around that to find some magic middle point just right, like Goldilocks found. And I think this is a constraint for policymakers, just as you suggested, making forward predictions of what's going to happen is also a mistake as well, because people are guided by that and make decisions around it. And if they're wrong, they can have, negative impacts on the economy generally.
Well, I think one of the big challenges the Reserve Bank's going to face is containing inflation expectations and inflation psychology, because if we believe inflation is coming, we're going to act differently. On the other hand, currently, households don't seem to be responding too much to the threat of higher interest rates. They're out there spending still, aren't they?
Well, they are, Michael, and we've still got the boom time mentality from all the handouts during COVID. And of course, this has been the genesis of our inflation problem, is that we were paid forward, which was fair enough given the uncertainty of the times. But now we're having to pay it back because it's clearly created inflation, too much demand, not enough supply. And that's now being exacerbated by a number of factors. We've run out of workers because we closed our borders. We have the lowest unemployment rate on record. That will mean higher wages, which will mean more spending, Michael. So it is the good times to some degree. We still have a lot of capacity to absorb higher rates, high savings levels, handouts from the government, rising wages. Of course, we have for mortgage holders that 3% buffer on new borrowings. And, the other point is that only half of households anyway have a mortgage. So, they're not affected at all by interest rates. They're certainly affected by inflation. And so therefore, they'll be pushing their wages up. So it's still good times for the Australian economy. And that means interest rates will continue to rise. I think it's interesting, Michael, if we look at the historical position for interest rates, typically interest rates from trough to peak have risen by around about 1.75%. And that's only on basically 3 occasions before, that they've reached that peak point. Now, we're already up by 1.25%. So I think that it would be logical to say that we've certainly got more than another 0.5% left in terms of interest rate increases to match the historical precedent. I don't want to be a fearmonger here, but if we go back to the period where we had similar inflation outbreaks to the severe one we have now globally, and we look at interest rates and are guided by perhaps the US, and that's through the early 80s, the US increased interest rates from 5% to 20% to get on top of inflation in the 80s. I'm not suggesting that's going to happen now, but what I am saying is that we've certainly still logically got plenty of upside for interest rates going forward. And that's basically because we're doing so well, Michael.
Well, various bank economists see the Reserve Bank lifting the cash rate to 2.6% by the end of the year. Andrew, the money markets, whatever they are pricing in a higher cash rate, 3.5% by the end of the year. And I think that's one of the things fueling fears about a potential economic slowdown.
The economic slowdown is the aim of the Reserve Bank, Michael. You have to stop people spending. How do you stop people spending? And if we've still got a full employment economy, we've run out of workers. We're dragging workers out of the population with our participation rate being the highest on record. So people who normally wouldn't be, interested in being part of the workforce are being attracted by higher wages. We don't have an inkling of a sign yet that what they're doing at the moment is working. I don't agree with the policy position. Why should we have to choose between full employment and inflation? So we either have one or the other. And now we're heading obviously for the other, which is higher unemployment to drag down spending. Spending showing no sign of easing, Michael. And those other outside forces that have been created, not just expectations, which will grow, as you suggested, but building costs are also still going through the roof. There's no sign of any easing in building costs for houses particularly. And all that does is constrain the level of supply or available houses for what is clearly an undersupplied housing market. So all these forces are really unique in terms of the cycle. So it's difficult to see that the Reserve Bank won't have to continue to raise rates over the foreseeable future. And when we get the inflation data out this week, it'll be data that reflects high oil prices through that June quarter. Thankfully, oil prices are starting to ease over concerns with prospect of a global slowdown. But other factors that are affecting inflation, Michael, too, and I know I'm going on and on a bit here because there are so many things to discuss, is the very high US dollar, which gives us, unfortunately, the prospect of importing inflation because the US is still a very strong trading partner of ours, and any imported goods from the US we're going to be paying a lot more for. And that particularly means a number of building materials.
So, Andrew, you've mentioned a couple of times about the increase in building costs, and they have soared over the last couple of years, creating havoc for some construction companies that just haven't been able to complete their contracts and close down, and creating issues for people looking to build their home. Now, I know that My Housing Market release regular building cost data. What are you finding happening out there?
There's no relief, Michael. This is, I think, the issue. We know building costs have been accelerating as a result of the home builder initiative from the previous government, and that created a chronic shortage of labour and materials, and we saw house building costs go through the roof, and that's been a significant contributor to inflation. But the latest data that we run a monthly index based on ABS data of building costs for houses. The May is the latest data available from the ABS. We have the monthly trend up 1.9%, and that's following the previous month's trend of 1.8%. And the trend has actually been accelerating over the past 3 months, Michael, after showing some signs of easing earlier in the year. The annual trend is now up 23% and again rising. This again will work its way into the inflation rate data.
Unfortunately, that's going to mean that a lot of new construction projects are just not going to be viable at a time when we've got a shortage of new dwellings or a shortage of dwellings in general. It also is going to put a floor under established home values.
Well, that's right. I mean, the price of a property, Michael, typically reflects the price of land, which is about consumer demand and factors such as affordability. The actual cost of a dwelling, the cost of the improvements is reasonably stable, 2 or 3% a year typically. But now we have the cost of house construction increasing by these extraordinary levels. It continues to put upward pressure on the price of housing, but from the cost base.
Now, we also regularly talk about the auction markets, and every Sunday you provide a very detailed report on LinkedIn where you break down auction results by houses and apartments and even by regions in the major capital cities, and we republish that on Property Update. But the auction markets are feeling a winter chill at the moment, Andrew.
Well, we shouldn't be surprised at that, Michael, because it is the middle of winter. We've all just come back from school holidays, those fortunate enough to have a holiday break, maybe chasing a bit of sunshine. It's been particularly cold this winter in Melbourne and Sydney. And of course, this is a time when property market takes a bit of a break anyway. That's been exacerbated, of course, by a lot of negative sentiment regarding higher interest rates and the prospect for housing markets. So it's all sort of come at once, but it is the quieter period of the season. So we would have expected lower clearance rates anyway. And of course, you know, we're coming off the back in every capital city market of a boom. So clearance rates are lower. But I think it's instructive, Michael, that clearance rates are still reflecting generally a balanced market between buyers and sellers. We look at current auction numbers, and they're certainly well below where they were a year ago. But as we've discussed, a year ago, they were at record levels, and that's because they were bouncing back from lockdowns. There was a lot of pent-up supply that was coming into the market. And in fact, the numbers that we're looking at now are similar to the pre-COVID winter numbers that we would expect in auction markets. And in fact, the results over the last 3 weeks, when we've really been at the pointy end, not just in terms of winter distractions, but also the hysteria that's being in regard to the commentary for the outlook for housing markets. And yet our clearance rates have been remarkably stable. They're still holding in the high 50s generally. The one market that's looked like it's moved back to the pack quickly is the Brisbane market, Michael. The Brisbane market had another sharp decline last weekend, and it's now tracking just above 50%, which is well below where it was just earlier in the year. So that's probably the outstanding result in terms of market activity. The rest, Melbourne, Sydney and Canberra, are not a surprise given how strong those markets were last year. Adelaide's still holding the line. It's still a market that favours sellers.
Well, we're coming up to the spring season. It'll be interesting to see if there is going to be spring selling or whether people are just going to sit on the sidelines. Eventually, people are going to realise that interest rates are going to reach their peak. Eventually, they're going to realise that inflation has now reached its peak and next year going to slow down. So there is a good window of opportunity for people who've got patience at the moment to look for the right sort of property and take advantage of the market.
Well, our mortgage rates, Michael, as I said, as we discussed before, there's plenty of capacity to absorb higher rates. Average mortgage rates are around about 5% at the moment. We only have to go back to when we previously had higher interest rates. When they peaked, the mortgage rate was up around 8%, and that was in 2011-12. And if we go back to our previous strong economy prior to 2010 and 11, which was 2007, we had mortgage rates there at 10%. So our mortgage rate's still well below where it was in other peak times of interest rate increases. And as we discussed earlier, Michael, there's plenty of offsets for higher rates now. And I think that's the point. If we could finish off with another fairy tale, and that's the boy that cried wolf, I think the screaming headlines about house price crashes tend to moderate over time, and particularly as interest rates will continue to rise. So the shock of higher rates will start to ease as well. And I think, those factors such as a booming economy, everybody's got a job, wages are probably going to start rising above 3% now, savings are high, and you still need to have a bigger house or a smaller house, or you want to move to the bush and to the beach, but you can take advantage of those that perhaps have been spooked by the negativity and, have decided to sell their properties. We saw that back in 2019, and it is those value opportunities that do tend to turn the market. So let's see if they'll start to activate the usual spring selling season, which is only really a month away now, Michael.
That's not long at all, but next week we're going to catch up and we're going to have the latest CPI figures and also your figures for the month of July. So we'll see how the market's performing. Look forward to catching up with you next week, Andrew.
Thanks, Michael.